Tom Tzitzouris is with Strategas. It's a Baird company. He's had a fixed income, but he's got a bounce off the great Jason Trennert as well. And you floored me with an analysis that 70% of America are voters that are small business and they're in the churn, and they only make up 5% of the GDP. Has the Fed left them behind in this yield environment?
Well, I would very much say so. The Fed, by overly relying on the Fed funds rate to tighten, has put so much of that pain on Main Street USA. It's almost as if we've decided there's too big to fail. Earlier this year, we decided their medium is too big to fail, medium-sized businesses, Silicon Valley Bank, Signature Bank, depositors there. So if that means that if there's large companies are too big to fail, medium-sized companies are too big to fail, the only place you can actually tighten in the U.S. economy these days is small businesses and households. And the Fed has done exactly that by overly relying on the Fed funds rate. With that said, balance sheet reduction is catching up with the bond market now, and we're seeing Treasury yields rise in the belly of the curve.
Okay, and we'll get there in one sec, which is the technical underpinnings of why we're seeing a sell-off. But to stick on the point that Tom was talking about, if you have such a swath of the voter base that is feeling this kind of pain, and if you have small businesses that account for a significant proportion of the jobs losing momentum, when does that start to trickle into a higher unemployment rate? When does it start to reinforce and then actually bring rates down because of slower growth?
Well, we were already at that point in March of this year. We were 48 hours from a recession, which would have been very deep, and then we had financial stabilization via liquidity injections. So when does it begin to bite again? Probably sometime between Christmas and, we'll say, Valentine's Day, when the consumer gets those late 2023 credit card bills in January, and you start to see a pullback. I don't see any sort of slowdown in consumption. We didn't see it in the data last week, so that suggests to us the labor market's going to continue to remain strong at least until the end of the year. But at some point in time, those higher interest rates are going to bite all corners of the economy, not just small businesses and households.
Are yields rising right now because of the perception of strength that is given by some of the bigger businesses that are much stronger?
I don't think so. I think yields are rising because we're finally seeing supply come in and really scare those bond vigilantes. The bond vigilantes are back, and they're pushing the term premium up on all treasuries, not just the front end of the curve now.
Well, they've been unleashed not just in the US Treasury market, but also in UK gilts and on bonds. What goes through my mind is that when you trigger through 5% and you see the curve moving so aggressively, do you think that we hit some kind of a point of where risk parity trades begin to get smacked, or where VAR limits at various trading houses get triggered? Do you think that we're going to go into that next evolution of where we see a real liquidation moment?
That's a tough question, because I think we've seen, now this is really the third substantial rise in 10-year Treasury yields we've seen over the last 3 years. Each time you've probably seen those VAR strategies take a turn of leverage off along the way. So the sensitivity today to a 5% is probably less than it was to a 3% 2 years ago, because they've taken, from what we can see, there's been some leverage that's come off. With that said, there's always another break point. I don't know if it's 502 or 517, or we might have already hit it at 490. But there's a break point here where you're going to see another round of leverage come off. And that's part of the reason why it's probably a multi-step process, but that's probably one of the reasons why we're seeing the S&P off again as well, and credit spreads inching higher, because I think we're getting close to that point again.
So who steps in here? This is the debate that the three of us have had for the past 2 hours, which is duration heroes aren't to be seen yet. Yep. You're trading above 5%. Insurance companies have a different accounting system. They don't need to come in and hedge themselves. Who steps into this bond market to cap yields?
Well, there's a good and a bad to this. The good is there's an
Give me the good.
The good is there's an enormous amount of plain vanilla core fixed income strategies that will just love to keep buying and buying and buying treasuries. The bad news is those are price-sensitive investors. They're not like the leveraged investors of the past. So they're going to basically come in after there's a concession. So Treasury supply comes in, yields tick a little higher, they come in and buy on the cheap. They're not going to be price-insensitive who will buy on any dip.
You are a grizzled veteran of this. I'm going to give you 2 ideas. One that we talked to Wei Li about at BlackRock, which is the bid walks away. All of a sudden on price, folks, not yield, price of bonds. The bid walks away, and the great Chris Whalen calls this the Whalen silence. You're out there, you're on your phone. This is the old days, man. As you'd buy tickets here, sell tickets here. You're on your phone, and you're going, I got $1 gazillion of the Trenner, you know what, and there's just silence. Nobody wants that piece of paper. Are we close to that?
Well, some would say we've actually hit that. There was a lot of fear about 30-year auction. There's a lot of fear about auctions on the front end of the curve over the last few weeks, saying there were even headlines.
What about desks? Norway calls up and they go, I got to sell a zillion years of that cranny of 2042. Is there somebody there to buy this garbage?
There is, but you're going to have to put in a price concession. That is, yields are going to have to push higher than what the market is trading at. And the Treasury is now no longer immune to this.
I said price concession, and the Bramo cam shook. I mean,
At what point?
That's the reality.
Just real quick here, Tom, to sum it all together, are you getting compensated for the uncertainty right now? Are you buying duration?
Yes, we would be. I think you're being fairly compensated. Our own measure of the term premium on the 10-year Treasury, it's above 100 basis points. That's a very important level, not just symbolically, but what it's telling you is that you're getting normalized cushion for that uncertainty. This is where you normally would be. So we feel you're being compensated. Doesn't mean we can't see yields tick higher here, but you're being compensated for the risk going forward, I believe, at this point in time.
Jason from a cigar bar in the East Side emails in and says, talk about me. Okay, let's talk about Jason Trenner. How does this fold in? How does your fixed income analysis fold into Jason Trenner's call on the equity markets?
Well, it makes us that much more bearish on the economy because we continue to see another source of stress for the consumer and now businesses picking up here. So what we're doing is we've delayed recession, and we've said we're going to avoid recession at all costs in 2023. But that itself, there's costs to that, and the cost is going to be that the breaking point is going to be when yields are higher, which means there's more risk of financial credit events. And
are you predicting that?
Nothing that we can see right now, but by the nature of those types of events, there are places you can't see them. So,
you can't see them.
So at a 5% 10-year Treasury, it's much more likely than it was when we were at 350.
Right.
So where it is lurking, that leveraged investor who is caught off guard, we don't know. We don't see that happening at this moment, but it's on our horizon.
Bottle it. Tom Tzitzouris there of Strategas there in fixed income, the effect across all of the American economy as well.